Right, moving on to the management, the top management of the newly listed Delhivery. Sandeep Basaria, the Executive Director and the Chief Business Officer, live with us now. Good morning, Sandeep. This is Nantara. So we've seen this.
How are you?
Good. We've seen the stock come under a bit of pressure since the IPO. What we've also seen is companies becoming more conscious towards profits. In the run-up to the IPO, you, the co-founder Sahil, and everyone has been saying you're not going to take your eye off the bottom line, that you're different from other consumer tech companies. You're like a SaaS company, a software as a service company, which is in the logistics business. So when we start this interview, let's start with that. For the new financial year, you're now listed. Any targets, any guidance that you can provide us when it comes to profits?
No, that's a great question, Antara. As I think we've repeatedly said that profitability and growth are not conflicting objectives for a company like Delhivery and shouldn't be. And I don't think that changes. I don't, we have not issued any guidance for the year, and we won't be issuing any forward guidances. But what I can tell you is that for us, volume growth and profitability are not at odds. Actually, our profitability comes out of volume growth. So we have to continue driving growth. We've built a scale business and it's scale sensitive. So as we get larger, our profitability automatically kicks in. And if you look at just what's happened over the last 4 years, there's a lot of talk about profitability. There's a metric that we track called service EBITDA. Now, service EBITDA is like operating profit. It factors in all fixed costs and all the variable costs that actually go into actually offering the services we do. And if you look across all the combination of all our businesses, whether it's part truckload, express, full truckload, cross-border, and supply chain, when you combine it all, service EBITDA actually over the last 4 years, in 2019, it was 2.5%. And we exited FY 2022 at 11%. So from an operating basis, we already actually are driving a lot of profitability, which translated into adjusted EBITDA of 1% positive for FY 22. Now, below that is just corporate overhead costs. And a lot of that spend actually is in 250 crores in FY 22 was spent on technology. So as we talked about our being a tech company, as we get larger and we drive more volume and throughput through our pipe, we automatically get more and more profitable. And mind you, we've done all of this while reducing the cost for the customer. We've reduced pricing for the customer by 20% in that period of time, and fuel prices have actually gone up by 35 to 40% in the same period of time. Despite that, we've been able to drive such a massive improvement in service EBITDA. So we're definitely not taking the eye off the ball as far as profitability is concerned.
Substantiate all of that for us with numbers. In terms of throughput volumes, how has that gone up? You're talking about margins improving. But if I see your numbers correctly, right now the EBITDA margins were close to the single-digit band, very low single-digit, 2 to 3% band, whereas your competitors are at 10 to 15%. What's the trajectory to move it up to that level, and what kind of timeline should we realistically expect to achieve that number?
So, volume growth is very strong across business lines. Express parcel alone, I think from a volume perspective, grew at over 80% last year. Part truckload grew at almost 65-70% in FY22. So across businesses, you'll see volume growth. Now, at $200 billion of underlying market size, Delhivery, which is the largest player, is close to 0.5% of the market. And the industry is fairly agnostic to a slowdown, right? We are somewhat a recession-proof industry. Because the question is whether the $200 billion market opportunity will grow at 5%, 10%, or 15%. It's still a very, very large market opportunity relative to the largest player, who's actually just 0.5%. So growth is given. It'll be really disappointing if we don't drive growth, because that's something that we have a clear line of sight as that we will be able to drive growth. And you're doing that using the same infrastructure that we had last year. So you will actually drive superior unit economics as you go through the year. Now, when it comes to us versus our peers, I think what that signals is that it is possible to make profitable companies happen within the space of logistics. But I think if we were trying to build 1,000 crore extremely profitable logistics business, we could have done that a few years ago. The opportunity is really to drive growth. And we're investing behind growth. I think it's a very different ballgame when you're trying to build a 7,000, 10,000, 20,000 crore logistics company. If you're trying to build a 2,000 crore logistics company and grow it at 5% per annum, sure, you just focus on profitability and it's done. But what will that look like when it's a 25,000 crore company? And we're going through that cycle because it's a multi-year story. It's a compounding story. It's not a story going public with a 2,000 crore company is not the end all of a company. This is the start of a fresh journey. And we are trying to drive that growth to make this into a 25, 30,000 crore company. And we're going through that cycle right now.
Sandeep, when you talk about having half the market share that you were just talking about, that's
half a percent.
But you have also boasted about the kind of volumes and the market share that you enjoy in the B2C express parcel business. Ahead of the IPO, we of course saw the acquisition that you made of Spot On, which the street now believes you're basically going to replicate B2C for B2B. Is that really the plan?
So, I think I think those are very pointed comments, Nantan. I think you're absolutely spot on, and not talking about the company Spot On here. In Express, we clearly are market leaders. I think almost 23-24% share of all Express volume in the country goes through Delhivery's network. And mind you, Express also has 2 large captive operators in that market. So within the non-captive space, our share is actually very, very high. And that's a testament to the fact that we're able to offer the service quality that customers want and offer the unit economics that customers want. So that's sort of a very large core of our engine, almost 55% of our business, and continues to grow faster than the overall e-commerce market. Now, when it comes to B2B, you're absolutely right. What we're trying to do is trying to build that same scale that we had on B2C, and that's why Spot On becomes very important for us, because together we move to a much larger plane. We are able to then drive, again, better unit economics. And the 2 businesses together actually really drive a lot of volume in our middle mile. And that really is what drives superior unit economics. We actually move B2C and B2B together. That's a unique thing. That's very difficult to do. And that's what drives overall unit economics down. So as we are able to push that down, we can replicate the same story of B2C on B2B, which is start offering better unit economics to customers at superior service levels. We move B2B at the same speed as B2C, which is, again, while offering superior unit economics, which is very, very difficult.
But when will the B2C business, which is a fast growing business, really reaches what is the critical mass where the business needs little in terms of expansion, little in terms of investment, and the operating leverage and the business leverage will kick back the margins higher?
So Nikunj, it's already there. We are already very, very large player as far as Express is concerned. It is that we're building the rest of the business lines, which is why you see a blended number. We don't report individual segment numbers. Now, B2C is a fast-growing segment of the market, but it is just focused on express parcels that are e-commerce parcels. Of the $200 billion market that I talked about, over 160, 170 billion opportunity will just be in B2B space, right? Actually, over 180 billion will just be in B2B space. That's a very, very large space. So we're trying to build both a very, very fast growth engine, which is B2C, and we're also trying to build the second, the B2B engine, which is growing off a very large market opportunity. And you're looking at a blended number. Overall, already a lot of the leverage is starting to kick in. Now, CapEx, for example, in FY19, CapEx was 10% of our revenue. In FY22, that's come down to 6.5%. And so, of course, that will keep coming down. Where are we investing in CapEx? We don't invest in land and building. So there will be no expansion related to land and building. We're asset light as far as trucks are concerned. So there will be no investment there. Our investment tends to go in automation. Trying to create, for example, we're going to be launching AMRs this year. These are automated robots in the hubs. We're going to do things like that, and we are launching our first robotic sorter later this year. We're going to continue investing behind all the infrastructure that goes into the hubs. So as we grow, hubs will grow. That's a testament of the growth. Bhiwandi is moving from 350,000 square feet next year to 7 lakh square feet. Bangalore is moving from 2.4 lakh square feet next year to 10 lakh square feet. And we made these announcements. Now, so obviously we'll continue to expand that, and that's a testament of growth. It is not a requirement to get to profitability for B2C Express.
Okay. Whom would you say is your global parallel? There is no parallel for you in India. But because when companies go public in India, we tend to compare them with a global parallel. How do I benchmark Delhivery? I cannot benchmark you against Blue Dart. I cannot benchmark you against Gati. And unfortunately, the business public markets are in, they like this comparison. It's a bad word, but yeah, chalta hai, comparison.
No, I think it's a fair thing to ask. And I think, we're new kids on the block. It's only been a month or so. I think people will learn about our story and they'll see the performance over several quarters, and that's when delivery will truly be discovered. And I don't think we are in this for the long haul, and we're trying to build a company for the future, so we don't really care about that. From a comparative perspective, I think yes, there is no real direct comparison in India because who do you compare us to? Do you compare us to the logistics companies? Well, we outstrip growth compared to them. We are very, very different. We're the only integrated player in the market. We're the only person who uses technology in any meaningful way. And our balance sheet is so strong. If you compare us to the consumer tech companies and those peers, well, we have the same growth profile as them. And we're actually profitable. And again, the same strength of balance sheet and the way we operate as a business is very, very different. But yet people don't look at us as the consumer tech companies. So if you compare us to the consumer tech companies, we're extremely cheap, right? Globally, also, I think we're inspired by companies rather than actually, you won't find a direct parallel for us. The reason you won't find a direct parallel for us is many of these businesses were built. So some of the large global express companies are built on B2C platforms or B2B platforms. They've not successfully moved to B2C, and they have not been successfully able to combine the two businesses. Also, many of them were marvels of industrial engineering in the 70s and 80s. They aren't really software-led companies. They're not technology-led companies, but they're starting to change. We're inspired by an UPS. We're inspired by a FedEx. If you look at people from the West, and at the same time, if you look at China, a ZTO, a Best Logistics, are potentially interesting people to actually compare us to. ZTO is actually starting to move to a model which is similar to ours. They were really a focused middle mile player in B2C. They did all their first mile, last mile using franchisees. The technology was provided by a company called China, which is Alibaba owned. So they were really a middle mile company, but now they're starting to change. They're starting to invest in their own technology. They're starting to build B2B and B2C together. So ZTO is a potentially good comparison to delivery, but there is no immediate peer for us. In many ways, we are like AWS. We're trying to build a pipe, which is very, very basic. It's a simple business, and we're trying to drive throughput through that pipe. So the one that probably we are most inspired by is probably AWS.
Yes, Sandeep, just wanted to quickly ask you about the business as well in terms of the overall realizations. And I understand that your revenue per kg for delivery is at rupees 10 thereabouts, which is 20% lower than the traditional companies as well. Going forward, is the strategy going to be just that you'll price it that attractively, that you'll keep gaining market share? And what's the market share target as well that you have in mind?
So I very specifically talk about one business line, which is the part truckload business line. We have 5 business lines, and so the pricing, yield, market share, everything will be very different for each business line. On B2C Express, as I said, we will be almost 23-24% share of the market. In part truckload, the market is highly, highly fragmented. It's very hard to actually pin down a share of anybody in that market because it's extremely, extremely fragmented. We're sort of I think we're the number 2 player in that space now with Spot On and Delivery combined. On FTL, the market is even more fragmented. I don't think anybody has even 1% share of the overall market. And that's really a brokerage business. And again, similarly in cross-border and supply chain, again, extremely, extremely fragmented, early stages. Post GST, supply chain is only just starting to really open up as companies start making decisions in supply chain. So I don't think it's so much as a share aspiration overall in logistics that we have. We see an opportunity to create a 25-30,000 crore company, and we have to get there. Question is, how fast can we get there, and how can we get there while being very prudent about the capital we've raised for shareholders and get their profitability? That's what we're going to drive. Now, as far as yield is concerned, we're talking about part truckload yield. Now, again, it's not as simple as saying it's 10 rupees per kilo, and because there will be players at 8 rupees also, and there will be players at 11 rupees also. But when it comes to e-commerce parcels, our yield is, as we exited FY22, we exited with about 72 rupees a parcel. That's a 1 kilo parcel typically. So then it's 72 rupees a kilo, right? So it's not a like-for-like comparison. 4 years ago, that yield was 93 rupees. So we've actually brought it down in that period of time from 93 to 72 rupees. Mind you, our yield is a blend of white goods and express parcel goods because we also do a lot of fridges and TVs and stuff like that.
Sandeep, sorry, we have a breaking news coming in, so we'll have to cut the conversation short, but we appreciate you joining us on the show and hope to speak with you soon.